Last year, over 60% of South African farmers who applied for the SARS diesel rebate got rejected.
Which is just a massive number.
Right. I mean, we're talking about money they were legally owed,
Yeah.
often hundreds of thousands of rand, millions of rand, just like vanishing from the agricultural sector.
Yeah, it's brutal. And the crazy part is the culprit wasn't bad farming.
No, not
It wasn't even bad math. It was literally a database field capped at 16 characters.
a 16-character limit. It's wild to think about. Just a tiny, invisible digital bottleneck.
Yeah.
And it silently truncated their data, corrupted the audit trail, and basically handed the revenue service a perfect excuse to decline the payout.
Exactly, which is, a devastating realization for any business owner. You spend millions on like high-tech combine harvesters, GPS yield tracking, all that precision irrigation.
Oh yeah, the physical tech is incredible.
Right, but if the foundational architecture holding your ledgers together is structurally compromised, I mean, the entire enterprise is running on borrowed time.
It's so true. So if you are joining us today, you are probably someone who wants to master complex systems.
Yeah.
You want to avoid audit failures and build infrastructure that actually scales.
Yeah, build something robust.
Exactly. So our mission for this deep dive is highly specific, but the principles apply to almost any data-heavy enterprise. We are exploring the blueprint for South African MSME agricultural operations.
Specifically, their transition to the new 2026 Chart of Accounts roadmap.
Right. We're looking at this stack of technical documentation that details the leap from an outdated, crash-prone legacy database to a modern, IFRS-compliant 4-digit by 3-digit architecture.
It's a huge leap, but it's fundamentally about survival. We're talking about a regulatory environment that is becoming increasingly automated and merciless, really.
Merciless is a good word for it.
Yeah, I mean, the days of handing a shoebox of receipts to a bookkeeper and just hoping for the best, those days are over.
Long gone.
The rules of the game are changing significantly in 2026, and your data structure, well, it has to anticipate those changes before they happen.
Okay, let's unpack this. I want to start by looking at this 16-character bottleneck.
Right.
Because the documentation opens with a really glaring warning about these older chart of accounts templates.
Yeah, the legacy setups.
Right, we were talking about previous versions of TurboCASH5-4 release candidate 2 and anything earlier than that.
Yeah.
The text explicitly states that these sets of books, they cannot be used as a base for any new templates.
Absolutely not.
I mean, I understand software gets old, but what is the actual mechanical failure happening here? What breaks?
Well, it comes down to a fundamental clash between how databases allocated memory decades ago, right, versus the reality of modern globalized data.
Memory allocation.
Yeah. Those legacy charts were built on a schema with incredibly rigid field lengths. So an account description was hard-coded to a maximum of 35 characters.
Wow, 35.
A group description was capped at 30. And batch types, those were limited to just 16 characters.
16. I mean, which is nothing. You literally can't even fit depreciation-harvester into 16 characters.
You can't. It just won't fit. But the problem, it isn't just the character count. It's actually the byte count.
Wait, what's the difference there?
So back when these systems were engineered, memory was really scarce. Databases were optimized for single byte character sets, primarily Latin 1.
Okay.
In a single byte environment, the database engine expects one keystroke to equal exactly 1 byte of data. It's a perfectly predictable 1-to-1 ratio.
1 keystroke, 1 byte. Got it.
But the modern business world, it operates entirely on multi-byte Unicode environments.
Yeah.
Specifically UTF-8.
Ah, right. So if a user types in a specialized localized character, maybe an African term with a diacritic,
Right.
or if the software is being deployed in a localized Arabic or Chinese environment.
Exactly. Those characters require multiple bytes to render.
Right. They're heavier digitally speaking.
They are. And that is exactly where the collision occurs. When a modern translation file, or, just a regular user, tries to force a multi-byte Unicode string into a rigid 16-character field.
A field that was only provisioned for single byte text.
Yes. The database engine hits an arithmetic exception. The Firebird database, it recognizes that the data packet exceeds the allocated memory block.
It's just too big.
Yeah. And it triggers what the documentation refers to as dynamic SQL error -303.
Wow. It's like trying to run high-octane racing fuel through a 1980s carburetor.
Oh, that's a perfect way to look at it.
The fuel itself is superior, right?
Yeah.
It contains more energy. But the physical intake valve of the engine is just too small. So the engine floods, it violently stalls out, and you They're basically less stranded.
That is a phenomenal analogy. The SQL engine throws a string truncation error. It attempts to, physically chop the word in half to make it fit.
Oh, geez.
Yeah, which corrupts the index. And then it typically executes a hard crash just to protect the rest of the database.
So this isn't just a minor glitch. Like, the screen doesn't just freeze for a second.
No, it physically stops the business from processing data. Full stop.
That's terrifying for a business owner. But the documentation points to a mandatory technical fix before any migration even begins, right? They state, you must run a database initialization script to expand the SQL field lengths to varchar 128.
Yes, the schema upgrade. It's critical.
So how does that work?
Before you touch a single account balance, you run a script directly against the Firebird database. This reallocates the memory parameters for descriptions and group structures, taking them from those tiny limits all the way up to a variable character length of 128.
Oh, so it just widens the length.
Exactly.
Yeah.
By physically widening that table structure, you instantly inoculate the engine against that SQL error NACTR 303.
That makes sense.
It basically creates a container robust enough to process any multi-byte UTF-8 string without triggering a truncation exception.
Okay, so we've widened the intake valve. The engine doesn't stall anymore.
Right.
But, having a bigger database doesn't automatically mean the data inside it is actually useful.
Very true.
The text highlights this massive credibility gap baked into the legacy templates regarding terminology. They rely heavily on legacy terms like debtors, creditors, and stock.
Yes. The terminology issue.
Now, if you are listening to this and you're running a mid-sized farm operation, you might think, who cares? I know what stock means. Yeah. Why does the software care what I call my inventory?
Well, the software itself doesn't care. But the APIs, the risk algorithms, and the commercial auditors, they absolutely do.
Oh, because of compliance?
Yes. We are operating under International Financial Reporting Standards, or IFRS. The whole financial world relies on standardized nomenclature to automate risk assessment.
So specific words matter.
Hugely.
Correct.
Debtors must be called customers, or trade receivables. Creditors must be suppliers, or trade payables. And stock absolutely must be inventory.
Because if a small farm applies for, let's say, a commercial expansion loan to buy a new irrigation pivot, that application doesn't just sit on a local bank manager's desk anymore, does it?
Not at all. It gets fed into an automated underwriting system.
Right.
Those Basel III compliance systems and OCR scrapers, they are parsing your financial statements looking for very specific IFRS-mapped keywords.
And if they don't find them?
If the API ingests a balance sheet loaded with terms like debtors and stock, it throws an exception, or it flags the file for manual review.
Which is bad.
Which immediately drops your internal credit scoring. It subconsciously signals to the entire financial supply chain that your operation is, unsophisticated.
Wow, just because of a word.
Yeah. By forcing the template descriptions to adopt modern IFRS terminology from day one, your system data aligns seamlessly with those commercial compliance manuals.
Which brings us to the actual architecture of this new system. We've stopped the crashes, we've fixed the vocabulary. How do we structure the shelves in this wider database so the auditors can actually find what they need?
Right, the layout.
The documentation outlines a shift to a 4x3-digit layout. What is that?
The 4x3 layout is really the structural foundation of the 2026 blueprint. It dictates that every single ledger account is built using a two-part alphanumeric code.
Okay, break that down for me.
You establish a 4-digit main account, that's the parent block, followed by a 3-digit sub-account, which is the child item.
Got an example?
Sure. So if your main account for operating revenue is designated as G4100, a specific sub-account for, say, maize sales that might be 100.
Oh, I see.
Yeah, so the concatenated string becomes G4100 euro 100.
Wait, if I'm just running a mid-sized agricultural operation, maybe a family farm, why can't I just use off-the-shelf cloud-based accounting software?
It's a common question.
Yeah, why am I going through the headache of pulling down a customized empty books 4x3 digits seed file and initializing a local Firebird database? Yeah. It feels like we're doing a lot of heavy lifting for something I could just subscribe to for $30 a month.
It's a completely valid question, and it really comes down to two things: data sovereignty and specialized functional mapping.
Data sovereignty, meaning who owns the data?
Right, and where it lives. Off-the-shelf SaaS products are built for mass market generalizations. They want a graphic design firm in the city and a local bakery to use the exact same logic.
Right. One size fits all.
But an agricultural operation has highly specialized, legally distinct asset classes, like biological assets under IFRS Section 34.
Like livestock.
Exactly. Generic cloud software simply cannot isolate those without complex, really messy workarounds. A customized 4x3 layout gives you the granular control required for specialized industry audits.
Oh, that makes sense.
And crucial for many farmers, it maintains local sovereignty over your data if you operate in areas with unstable internet infrastructure.
Right. Out in rural areas where the connection drops, you can't have your sauce product freezing up on you.
Precisely.
I see. So it's about building a bespoke, bulletproof environment. Now, the text mentions 3 core initialization anchors you have to verify when you open that seed file.
Yes, the anchors are vital.
We have G100 HEO to 100 for accounts receivable, G2100 100 for accounts payable, and G300 to 500,000 for retained earnings. Why these 3?
Those are your double entry control parameters. They essentially act as the gravitational centers for the entire ledger.
Gravitational centers. I like that.
Yeah, if those 3 anchors aren't properly mapped, the fundamental accounting equation, assets equals liabilities plus equity, just breaks down.
Just falls apart.
Totally.
Yeah.
The software literally can't auto-generate a balance sheet if it doesn't know where those 3 gravitational centers are.
Okay, let's look at this from the perspective of the beginner, though. The documentation uses this phrase, micro-simplicity.
Yes, I love that concept.
But if I am transitioning from a shoebox of receipts, looking at a wall of 7-digit alphanumeric codes is terrifying.
Yeah.
I mean, how does this layout not completely overwhelm the end user who just wants to, categorize a fuel receipt?
It sounds scary, but it's actually brilliant because of how the 4-digit prefix logic works. The beauty of this modular architecture is that it operates on dual layers.
Dual layers. How so?
To the beginner, those 4-digit blocks just look like simple, intuitive sorting buckets. Let's take the 1000 to 1999 block. In this blueprint, that entire block is universally bound to assets.
So a user just opens the 1000 block and sees what? Cash, tractor, land.
Exactly. They select tractor and process the receipt. They don't have to think about the remaining digits at all.
Oh, so they're just tossing apples into the apple crate. They don't need to know how the crate was built.
You nailed it. But underneath that interface, the SQL architecture is doing something incredibly sophisticated. Because that specific 1000 block is structurally bound to asset behavior, the database is automatically tagging that transaction.
Tagging you for what?
To comply with IAS 16 for property, plant, and equipment, the beginner user experiences 0 friction, but the software is actively compiling an audit-ready, standardized ledger in the background.
That's actually really smart.
It holds the DNA needed to scale without demanding that the user understand advanced accounting theory.
It perfectly sets up the problem of scaling, actually. Because a business grows, right? You go from micro-simplicity to suddenly needing formal compliance.
And that transition is usually rough.
Yeah. Sections 3, 4, and 5 of IFRS for SMEs demand that financial statements categorize elements by liquidity and operational function. If you've just been tossing things into basic buckets for 5 years, transitioning to a formal reporting structure is usually a nightmare.
An absolute nightmare.
You have accountants billing hundreds of hours trying to untangle whether a specific line item was an operating expense or a cost of sale.
Which is exactly what we avoid with what the documentation calls the zero-friction migration path in this new architecture.
How does the database anticipate that problem?
Through the use of 2 specific data fields applied at the root level. They're called sgroup P1 and sgroup P.
sgroup P. So instead of trying to figure out what a transaction was 5 years later, the system forces a categorization at the moment of creation.
Yes, exactly. Every single account in the 4x3 layout is permanently assigned to an explicit group tag. So sgroup 1 might declare non-current assets, while sgroup 2 declares operational expenses.
Okay.
Because these relational tags are embedded in the schema from day one, an auditor's reporting software can run a simple SQL query, and that query instantly groups those tags into statutory financial statement formats.
Instantaneously.
Yes, there is no manual account splitting required. The system cleanly calculates intermediate profit tiers, like gross profit versus operating profit, instantaneously.
Wow, that saves so much time and money. Let's dig into how this applies to the specialized agricultural accounts, because this is where generic software really falls apart.
Oh, absolutely.
The blueprint details a very specific restructuring of the asset blocks to comply with IFRS for SMEs Section 17, which is property, plant, and equipment, and Section 34, which is specialized activities. It starts with the G1500 block. What's happening there?
G1500 is structurally isolated purely for agricultural land. And mechanically, land is totally unique in an accounting database.
Because you can't depreciate it.
Exactly. It possesses an infinite useful life. It does not degrade. Therefore, the software must never apply recurring depreciation algorithms to this block. It sits on the balance sheet at historical cost or revalued amount.
Okay, so land is protected in G1500. Then we move down the ledger to G1540, which holds movable assets.
Right, this is your mechanical infrastructure. The tractors, the harvesters, the irrigation pump.
That's stuff that breaks down.
Exactly. Unlike the G1500 block, these mechanical assets absolutely wear out. The database must provision dedicated child sub-accounts under G1540 for accumulated depreciation.
To track the wear and tear.
Yes, running straight line or diminishing value calculations to track that loss of utility over time.
So land and machinery are cleanly separated. But then we hit the core of farming, the biological assets.
The living things.
Right. The dairy cows, the sheep, the orchards. If I'm an accountant, I cannot depreciate a pregnant dairy cow the same way I depreciate a John Deere tractor. I mean, it doesn't make any sense.
You absolutely cannot, which is why IFRS Section 34 exists. And it's why this blueprint dedicates the G1600 block entirely to biological assets.
How does the map work on a living thing?
Well, a dairy cow undergoes biological transformation. It grows, it calves, it produces milk. Its market value fluctuates based on age and commodity prices. It requires fair value accounting models, not historical cost depreciation.
So by structurally isolating G1600 away from G1540, the database acts as a firewall.
That's a really great way to frame it. The tax practitioner can run complex fair value adjustments on the livestock without the SQL query ever accidentally sweeping up the mechanical asset codes and corrupting the depreciation schedules.
It's mechanically impossible to mix the valuation model.
Exactly. It eliminates ambiguity.
And speaking of ambiguity, the documentation highlights a massive vulnerability in the old legacy layouts. It calls it the developer's nightmare.
Oh, duplications.
Yeah, duplications. Having a G6500 account for marketing and a completely separate G6350 block, also used for marketing and selling. Why is that so destructive to a database?
Because it destroys the predictability of bank statement matching rules.
How so?
Well, think about it. If you are trying to automate your data entry by having the software read a live bank feed and auto-categorize expenses, the algorithm needs a binary choice.
Right.
If it sees an invoice for Facebook ads and it has two different marketing ledgers to choose from, the rule just breaks. The software doesn't know which account is the authoritative source.
Oh, I see. So you end up with split postings. Half the commission data lands in one ledger, half in another. And the poor auditor has to manually reconcile this fragmented data.
It's a huge waste of time. The 2026 roadmap ruthlessly wipes out these redundant blocks. It enforces a single source of truth row sequence.
Single source of truth.
Yes, every specific expense or asset has exactly one permanent home. It forces the user and the automated bank feeds into a singular operational lane.
All right, so let's summarize where we are. Our database isn't crashing. Our terminology passes the Basel III API checks. Our assets are perfectly segregated into land, machinery, and biological blocks. And we have a single source of truth for every bank feed.
Sounds like a solid business.
It is. The enterprise is structurally sound, which means it's going to generate revenue.
Hopefully.
And the moment an MSME crosses into serious revenue, it crashes headfirst into the most heavily penalized component of the entire system.
Yes, taxes.
Taxes. Navigating the tax thresholds is where this architecture shifts from being an organizational tool to an active legal shield, isn't it?
It really is. It stops you from making catastrophic mistakes.
This brings us to a really fascinating product design decision in the documentation regarding the 2026 VAT setup. It states that the entire G200,000 VAT ledger sequence, the whole tax engine, basically is disabled by default upon installation.
Locked down tight.
Yeah. You literally have to go in and override the system to turn it on. Why build a complex tax routing subroutine and then deliberately lock the user out of it?
This is what we call a masterclass in defensive system design.
Defensive systems.
Yeah, making the legally dangerous action structurally impossible until you are officially authorized to execute it. In South Africa, a sole proprietor or micro business is legally prohibited from charging VAT on their outgoing invoices.
Right.
And they cannot claim input VAT on their operational purchases until they are formally registered as a VA vendor with SARS.
So if the software shipped with those tax subroutines active by default, what is the failure mode? Like what actually happens to the farmer?
The failure mode is accidental statutory fraud.
Wow.
Think about it. A beginner farmer opens an invoice template to sell their first crop. They see a drop-down box for VAT, assume they are supposed to apply the standard 15% rate, and they issue the invoice.
Because the software let them do it.
Right.
Yeah.
They collect that 15% surcharge from the buyer, but because they have no formal registration, they have no legal mechanism to remit that collected tax to the revenue service.
Oh, no, so they just keep the tax money.
Yep. They have unlawfully enriched themselves under the guise of state taxation.
Which carries severe penalties, I imagine.
Incredibly severe penalties, audits, and immediate blacklisting.
So how does the layout prevent this?
By disabling the T24,00010 through T24,00180 child accounts at the root level, the database physically locks out the interface's ability to map a tax rate.
Huh?
Even if the user tries to add VAT to an invoice, the backend has nowhere to route the calculation, so it simply rejects the action. It protects the microbusiness from its own ignorance while they focus on early-stage growth.
That is amazing. And it's not just about preventing mistakes either. The text connects this disabled VA block directly to the SARS turnover tax system.
Yes, the turnover tax bonus.
If the ledger is disabled, all the expenses and revenues are posting as gross amounts, right?
Exactly. And the turnover tax is a highly simplified tax framework designed specifically to keep microbusinesses out of complex corporate income tax calculations.
It's just a flat rate.
You just pay a flat micro percentage based purely on your top-line gross turnover.
And as of the April 2026 legislative update, SARS aligned the maximum threshold for turnover tax to be exactly 2.3 million rand, which is precisely the same threshold for compulsory VAT registration.
It is a deliberate policy alignment.
Right.
As long as your rolling 12-month revenue is under 2.3 million rand, you keep your VAT block disabled. Your software naturally generates perfectly clean gross value income statements.
Which makes tax season a breeze.
Exactly. Your tax practitioner can run the turnover tax bracket calculations in seconds because there is no fragmented input or output VAT data polluting the gross figures. It's a dual-purpose firewall. It prevents VAT fraud, and it mathematically optimizes the ledger for turnover tax compliance.
That's just beautiful system design. But inevitably, a successful operation is going to breach that 2.3 million rand line in a 12-month period.
Hopefully, yes, that's the goal.
Or, they might hit the 120,000 rand threshold for voluntary registration, decide they want to claim back the 15% input VAT on a massive capital purchase, like a new tractor.
Very common scenario.
When that day comes, how does the 4x3 architecture handle the transition?
It requires surgical precision. You cannot simply toggle the database to active and pretend you were registered all along.
Right, you can't fake history.
The first non-negotiable step is verifying your exact SARS VAT registration effective date.
Because legally, you can only begin charging output VAT and claiming input VAT from the precise day SARS grants you vendor status.
Correct. If your effective date is June 1st, and you go into the ledger and apply input VAT to a fertilizer purchase made on May 28th, you will instantly fail your first audit.
So the historical data is locked.
Every historical posting prior to the effective date must remain locked as a gross figure.
So once we cross the threshold and we receive our official date, what is the actual technical process to turn the engine on?
You navigate to the parent control database layer.
Yeah.
You locate G2400,000, which is the primary VAT control account, and execute a status change from disabled to active.
Just to flip the switch.
And that propagates down to all the child accounts. You are fundamentally opening the database lanes to start accepting subledger balances, which allows the pre-mapped SARS-compliant input and output reporting matrices to function.
Wow.
You flip the switch, and you transition from a microenterprise into a fully fledged, auditable VAT vendor.
Which unlocks the final and arguably the most high-stakes mechanism in this entire blueprint. If you are a registered VAT vendor in the agricultural sector, you suddenly have access to the SARS diesel rebate scheme.
Ah, yes. This is the financial lifeline of the South African primary sector.
The documentation notes that SARS has increased the on-land primary sector rebate from 80% to 100% of eligible diesel used in qualifying activities.
Which is massive.
Yeah, if an operation is burning tens of thousands of liters of diesel a month, powering heavy machinery, recovering 100% of the tax levy on that fuel is a massive injection of liquidity.
Game-changing money.
But we're back to the statistic I mentioned at the very beginning of this deep dive. Over 60% of claims are rejected by SARS due to poor paperwork.
And SARS audits these claims with brutal scrutiny, precisely because of the immense capital involved.
Right.
If your chart of accounts cannot provide an unbroken, mathematically perfect audit trail tracking the exact volume of fuel from the moment of bulk purchase to the storage tank and mapping it directly to an eligible operational task, the auditor will disqualify the entire claim.
Wow. Okay, so before we look at the software, what are the actual rules of engagement here? This scheme is governed by Schedule 6 to the Customs and Excise Act. What makes a liter of diesel eligible?
The foundational rule is that you must be a registered VAT vendor and you must purchase the bulk fuel directly. You cannot engage in wet contracting.
Wait, wet contracting, what does that mean?
That's when you hire a third-party contractor to harvest your fields, and they bring their own diesel, and they just bill you a single invoice for harvesting services.
Oh, I see.
Yeah, you cannot claim a rebate on fuel you didn't directly purchase and store on your own property.
Okay, so I buy a 10,000-liter bulk tank directly from the supplier. It's sitting right there on my farm. What is the line between eligible and non-eligible usage?
SARS only rebates fuel consumed during primary production.
Primary production meaning?
Tilling the soil, planting the seeds, running the harvesters, pumping the irrigation lines, and moving the raw produce from the physical field to the absolute first point of delivery.
First point of delivery.
Yes. Usually that is the local cooperative silo. Every drop of diesel burned doing those specific tasks is 100% eligible.
So non-eligible usage is basically everything else.
Exactly. If you put diesel into your farm manager's backy to drive into town for a meeting with the bank, that is non-eligible.
Even though it's for the business.
Doesn't matter. Not primary production. If your transport truck takes the harvested crop past the first point of delivery, say, transporting it to a retail distribution center in Johannesburg, that transport occurs on public roads and is strictly non-eligible.
Wow, okay.
Furthermore, the fuel consumed by that truck returning empty to the farm is also non-eligible.
That is an incredibly strict line. I mean, how on earth do you prove to a forensic auditor exactly which drop of diesel from a 10,000-liter bulk tank went to the harvester and which went to the transport truck?
Through rigorous adherence to the 2 logbook rule, this is where the 60% of farmers fail.
2 logbooks.
Yes, you cannot just hand an auditor a spreadsheet with an estimate. You must maintain 2 independent intersecting records.
Okay, what's the first one?
First, a storage logbook. This records the bulk pool, the exact capacity of the tank, daily dip readings, and every single dispensation event out of the nozzle.
Like physically measuring the tank?
Yes, physically dipping the stick.
Yeah.
Second, a usage logbook. This tracks the asset level consumption, so the specific engine hours, the odometer readings, and the exact task performed for every single machine on the farm.
Good grief.
And these logs must be retained for 5 years.
5 years. So we have this massive, complex physical tracking requirement. How does the 4x3 chart of accounts architecture actually translate those logbooks into a ledger that survives an audit?
It's all about the workflow.
Walk me through the exact accounting workflow. Step 1. The bulk purchase. The fuel truck arrives and fills my 10,000-liter tank. What do I do?
When you process the supplier's invoice, you record the gross fuel cost, excluding the standard VAT, directly into expense account 4510, which is your A property. Total purchases for fuel and oil.
Okay, 4510.
The absolute critical mandate here is do not attempt to calculate or guess the rebate portion at the point of purchase.
So don't try to be clever and anticipate the refund before you've actually burned the fuel.
Right. At the moment of purchase, the diesel is just sitting in a tank. You don't know its final operational destiny.
True.
So within the SQL database, that bulk purchase simply hits the gross expense ledger. You treat the tank as a virtual stock location.
Okay, step 2. Monthly usage. The month ends, and I have to reconcile my logbooks. Let's use the hypothetical data from the documentation. My storage logbook shows I pumped exactly 4,000 liters of diesel out of the bulk tank this month. I cross-reference my usage logbook, and it proves that 3,200 liters went into the tractors for harvesting, which is eligible.
Perfect.
The remaining 800 liters went into the backies for town trips. Non-eligible.
Okay, so you isolate the 3,200 eligible liters. Let's apply a hypothetical legislated SARS rebate rate of 4 Rand per liter. 3,200 liters multiplied by 4 Rand gives you a calculated rebate claim of 12,800 Rand.
Okay, 12,800.
The state owes you 12,800 Rand. How do we map that into the architecture? We create a journal entry utilizing a contra expense account.
Let me stop you there. A contra expense. Why wouldn't I just create a ledger called SARS refund and map it as other income?
I mean, money is coming into my business, right? It feels like income.
It feels like income, yes, but structurally treating it as income corrupts your operational reporting.
How so? The government isn't paying you a dividend to farm. They are returning a tax levy you already paid on a raw material. Standard IFRS accounting practices dictate that you must accurately match your operational expenses.
Oh, I see.
If you log the rebate as random other income, your 4510 gross fuel expense account still looks artificially massive.
Oh, I see the problem. If I'm looking at my internal profit and loss statement, I don't care about gross fuel. I need to know what it actually cost me, net of taxes, to run those tractors. Otherwise, my cost of production metrics are completely distorted.
Precisely. This is why the Blueprint Provisions Account 4519 specifically named SARS diesel rebate recovered and positions it directly beneath your gross fuel account 4510.
So they sit right next to each other.
Exactly. A contra expense account acts as a negative expense. By booking the 12,800 Rand into 4519, the automated reporting instantly nets the two figures against each other.
That's so clean.
Management and the auditors see the gross fuel cost minus the verified recovery, revealing the true mathematically accurate net cost of fuel for primary production.
That is incredibly elegant. So the actual double entry journal for the month is debit account 2400, which is a provisional asset ledger, stating SARS owes me 12,800 Rand.
Right.
And credit account 4519, the contra expense, effectively shrinking my operational fuel bill by 12,800 Rand.
You've got it perfectly. That sequence perfectly aligns your digital ledger with the physical reality of your two logbooks for that specific tax cycle.
Which brings us to the final step, submission.
The most important part.
The math is done, the ledger is balanced, and I'm ready to submit my VAT 201 return to SARS via the e-filing portal to actually get my cash.
The moment you formally file that return, you must execute a final transfer in the database.
What's the transfer?
You clear the 2400 provisional asset down to 0, and you shift that finalized, legally submitted claim into G2400-800, which is designated as the SARS diesel rebate settlement account.
Wait, why the extra step? Why not just leave the balance sitting in the provisional account until the money actually clears the bank?
Because you have to anticipate the audit mechanics. SARS doesn't just look at a single massive VAT pool anymore.
What do?
The documentation notes that SARS is actively rolling out dedicated, decoupled platforms specifically designed to isolate diesel refunds from standard VAT returns.
Oh, so they are looking at them completely separately.
Yes. By forcing the finalized claim into the G2400-800 settlement account, you structurally separate it from your standard VAT input-output transactions, and you separate it from the ongoing, unsubmitted daily fuel usage accumulating in the next month's provisional account.
You are basically building a quarantine zone for the submitted data.
Exactly. If a forensic auditor flags your July submission for review, you have an independent, crystal-clear ledger balance in G2400-800 that perfectly matches the 12,800 Rand submitted on the e-filing portal.
That makes an audit so much easier.
There is zero commingling of funds. There is zero ambiguity. It provides the auditor with a frictionless path to verify the claim against the logbooks, which transforms a high-risk gamble into a simple, predictable sign-off.
Wow. When you look back at the scope of this entire journey today, the transformation is staggering. We started with a ticking time bomb, a legacy Firebird database engineered in the 1980s that physically couldn't process a modern UTF-8 multi-byte character without suffering a string truncation and violently crashing the system.
Yeah, we've come a long way from the crashing.
Yeah.
And we saw how upgrading that schema to Varchar 128 was just the physical foundation.
Right. The real power is the invisible architecture built on top of it. This 4x3 digit layout acts as a silent structural guide.
It really does.
It takes a beginner, someone who doesn't know the difference between historical cost depreciation and IFRS Section 34 biological fair value models, and maps their simple everyday data entries into compliant international standards.
Behind the scenes.
Yeah. It physically shields them from committing accidental statutory fraud by keeping the VAT tax ledgers locked down until they legally cross the 2.3 million Rand threshold.
That's the defensive design at work.
And finally, it perfectly aligns their expense ledgers to survive the most grueling SARS diesel rebate audits. unlocking massive cash flow recoveries without the constant fear of rejection.
If we step back and connect this to the broader philosophy of system architecture, it really changes how we should perceive the tools we use to operate.
How so?
Well, if an accounting framework can act as a behavioral guardrail, preventing catastrophic legal errors simply by defaulting certain blocks to disabled, or enforcing a single source of truth to eradicate split postings, how else might we design our operational software?
That's a great question.
We should demand systems that don't just passively record a business's history, but actively protect its future through structural integrity.
That's a phenomenal thought to end on. Defensive system design. Software not just as a ledger, but as an active shield. It brings us right back to that high-octane fuel and the 1980s carburetor. You can have the most powerful, aggressive growth strategy in the world, generating massive momentum. But if the structural intake valve your database layout isn't wide enough or smart enough to handle the flow, none of that potential matters. Build a better engine, and you can scale the entire enterprise.
Well said.
If you are managing a growing operation, scaling a startup, or you are just fascinated by the invisible mechanics that keep the commercial world turning, we hope you keep questioning the architecture around you and keep applying these structural concepts to whatever systems you manage in your own life. We'll catch you on the next Deep Dive.